So let me know when you see the.
None of these departments, Bobcat, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker. None of the employees or its personnel gives investment financial advice, makes investment recommendations, or are any of them in the business of corporate trade, directing client details, or giving features to investors or situation. Nothing contained in any part of this broadcast on its website, materials, consultancy, solicitation, recommendation, promotion,
Good morning, everyone. It is time for Process Warriors again. It's the continuing saga that will never end. We're every time Mitch and I are talking about the shows, we always keep coming up with more and more stuff. I know maybe it seems overwhelming. There's just a lot of little things that are helpful in doing the process that will get you to a very scalable business that gets you to walk your talk and to do all the things that you're hopefully moving toward, right, Mitch?
That's right.
Yeah, we spend a lot of time trying to make this thing as streamlined, as easy for you guys to use. We've got things we're working on and behind the curtain that we're going to reveal in the next several weeks that we're excited about. Just a lot of things to help this process move forward. It's actually pretty amazing. Every time I look at our fact sheets and go through all of the stuff that we have, I just continue to, I guess, be impressed with the work that the software has been able to present and to put out in the world. When it's done completely correctly right, it is just an amazing way to run your business. And I know some of you know that. Some of you are still trying to get there. Maybe some of you are still working on believing that it's going to work that way. So that's the point of this show, and we realize we have different levels of folks at different phases within grasping the process. We brought in several new clients in the last few weeks, and it just it's a process to get there. So
Right.
So we'll go ahead. I'm first up. I am going to. Mitch, I'm going to bring you up to do the introduction here.
Okay.
And you go ahead and take over here for a few minutes. And
All right. So where we left off last time on Process Warriors, we were talking about mutual fund and ETF strategies. We really just started delving into it. We talked about some of the existing premier portfolios and also talked about the fact that you can use proxies to do this in various forms, whether it's with variable annuity accounts or at your custodian if you happen to have some non-transaction fee assets available to you. And as we discussed last time, we are going to be rolling out this week some new portfolios under the Premier subscriptions. So probably if you're watching this recorded, by the time you're seeing this, you should be able to find that up there. We don't have it up right this moment at the time of broadcast, but we are going to have this out before this week is over. So I'm really excited to have that put out there because it's going to really provide you with a lot more options depending on who your custodian is, as far as whether you want to use the original Premier portfolios or if you want to look at the non-transaction fee versions of that. You can see what the returns are, how it's performed, how much activity there's been on these different strategies from one to another, and you can see if it really makes sense to stick with the non-transaction fee version or to stick with the original Premier portfolio. So I'm really excited about the introduction of this. It's something we've talked about for a long time internally. We just had to get everything situated on our end, and now we're going to be able to roll this out, and we're also going to start producing fact sheets around these as well. So we're going to have a lot of material on our end that we're going to be putting out to you folks in the coming days and weeks around this.
Yeah, it always becomes somewhat obvious we can't walk and chew gum. So,
Yeah.
I guess the standards we're trying to keep out there to get this stuff together is also part of it, and making sure, because we realize that when you folks embrace these things, this is affecting your businesses, and that, we're a B2B business, so our business is as good as your business. So anyway, that's why we're always working on that.
That's right. So one of the things that we just started to talk about, I touched upon it last week, but because of the proxy conversation, we really didn't get to talk about this idea right here of a well thought out versus a kitchen sink portfolio. So one of the things that I did today is I went ahead and created a nice little sample kitchen sink portfolio that I'd like to dig through. An advisor also contacted us asking for a portfolio review. And so what we're going to do is I'm going to have Bob review a portfolio that this advisor created live on the air, sight unseen, and we'll see what we come up with this. So I'm looking forward to doing that.
That should be interesting.
It should be interesting.
Yeah. I think that will actually bring up a lot of things, and we can have good conversation when we're looking at what somebody has built. So have we disguised the name, I guess? No.
Yeah, I don't believe that there anywhere on there is the username of the advisor. So
okay. All right.
That we should be all set with that.
The
so
name
we'll
looks familiar. It's probably you, right?
Yeah, that's right.
Okay.
So just think of this as some special one-on-one time if this is your portfolio. Otherwise, this is a good learning experience, I believe, for any other advisor that happens to be watching this.
Maybe it's a good learning experience for me today.
We'll see.
It's all good. I like doing things live like we do with Market Thunder, because it's just live, and we're going through stuff, and that's the best. It's just like as if you folks were sitting here in the office with Mitch and I, even though we have 1,000 miles of dirt between us.
Right.
Something like that.
A lot of flyover country between the two of us right now, even though it's a couple inches on the screen.
Yep.
So we already talked about this before, but I'm going to keep hammering this home because you're going to see some of this in the kitchen sink portfolio. First off, do not use money markets. Let us handle the cash position. We already talked about that. And then really what the kitchen sink portfolio is that I created today is the idea of, I went out to Guggenheim and I grabbed all of the better part of their ETF list, and I just dumped it into one strategy. And so we're going to see a couple different things when we start digging into this portfolio. But that's something that you don't want to do. It's something you want to avoid, and I'm going to show you what that looks like on this sample thing. We're going to come back to watch lists a little bit later, talk about how you can make use of those within your practice, and really to get things going, I thought it'd be good just to start off with this live portfolio review. So as I said, an advisor contacted us, created this income-oriented portfolio, didn't give me any sort of thought as to, or any sort of basis as to why it is that he created this portfolio. He just simply said, hey, can you take a look at it? So on my end, I've already pulled up this portfolio. It's all the way at the bottom of the page, Bob, if you just want to go ahead and scroll down.
Okay.
I'll let you do the initial driving on it.
Right here?
You got it.
Okay. Let me move us around a little bit. Actually, I just don't have the right screen set up today. I'm not sure why. I'm going to have to. I'm just going to go to a full screen of VPM 2.0.
Okay.
And as always, at least I have my glasses right here this time, so I can get to them. They're dirty though, and that's interesting. Anyway, what we want to. So we're going to start the review here. Mitch, do you have any history on this as well?
I have nothing to be able to provide you with. So I thought this would be a fun live exercise, because this is, to be honest, this is what we typically have to go through on our end when we're given a portfolio. An advisor will create it, say, take a look at it, and there's no explanation given quite often. So this is going to be a fun little exercise, I think.
Yeah. It looks like a mostly bonds with a couple stocks in here.
Right.
That's interesting mix. Yeah, and there's nothing wrong with it, with putting mixing them like this. It just it looks like about 80-20. Looks like the stocks kind of got thrown in there for hope that it'd bring up the returns or something. I'm not sure what was going on here. What's your thoughts on?
Yeah, that was my thought. Is initially probably the ETFs were grabbed because they're pretty familiar names when it comes to ETFs. Obviously, Vanguard is nice, cheap securities, low cost. So advisor probably grabbed this thinking, let's grab some pretty familiar names. Probably looked at the returns on this and thought, well, let's try to spruce it up, see what type of stocks are out there that are also paying out some dividends that might be able to lift this performance up a little bit higher.
Yeah. So don't take anything personally if this is yours.
Yeah.
This is just a critical review, because this is what you want here, is to be able to get to that level and to be able to do that. So so like I said, we got intermediate bond. We got some Vanguard stuff in there, like Mitch said, some low cost. Oh, we got Snapple in here.
Yep.
So this, we see this a lot where, hey, I really like Snapple, so I'll throw that in. I mean, this should even be, in my opinion, a bond portfolio or not. I mean,
right.
It should be all, and if it's dividends, bonds, okay, that I can get that. But you don't want to. Well, I'm just going to throw one stock in there, because one of the things that let's take a look at. One of the first things we're going to look at when we're doing a review is to look at the settings. So I can go in here real quick. I'm going to pop up these settings here. Let me see if I can make it. Actually, it should be big enough on the screen for you
Yep.
folks to read. So we got beginning equity, 50,000, minimum transaction. Another issue right here, low activity, high liquidity.
Yep.
The settings were never changed. It looks like there. Some of the perceptions, whenever you're doing this type of strategy, which is index based, with the exception of Snapple, and I think there are all other.
There might have been one or two other stocks on there.
Yeah. So what you want here is you don't want to blend those things together, and because this is actually a small kitchen sink, is what it ends up being. It's not a big kitchen sink like Mitch is going to show you his big giant kitchen sink with how many funds are in that, Mitch?
The other one only has 29, but that's quite a bit for an index-based approach. So in this case, it's a large index kitchen sink.
Yeah. So what we want to see from a good quality build is we want to see some consistency in style box, whether it's a bonds or whether it's a blended strategy, whether all that. Want to see that continuity. So if you go back to what we've been doing on this show, is we're always trying to get this this for you to write up what this is supposed to be in the first place. That way, it helps you to to keep your constituents in a place where you're consistent across the board. Because let's say with the individual stocks in here, we'll just go down that path for a second. What goes in there next? Snapple, is it Exxon? I mean, or what is it? What's causing you to choose those stocks? So it's usually typical. One of the things that we have here, you have an allocation factor of 12.76, and so when Snapple comes in, depending on what point in the cycle it is, it's going to be a big bet. 12, almost 13% of your portfolio in a individual stock could get a little scary if you happen to step on a mine and these guys have some financial issue or they miss, and the market participants get a little excited and really sell this thing down, and they can really knock it down really hard. So that's an issue. And right away when I see this setting, low activity, high liquidity, that's going to tell us that this capital is probably not being used very well. So I'm going to go back down and bring that portfolio up again. And of course, for some reason, my my screen is not showing. Oh, there we go. I just got to move it over a little bit. I've expanded the size of it so we could see it. And so we go to the, we're going to go to the trade profile.
Yep.
And this is like step one. Look at this. This portfolio is never going to, there's probably, this brings out all the issues that are in this portfolio.
Right.
And Mitch is smiling almost.
It's funny because I've already done my part of it to do an initial review on it. It's just fun seeing you go through all these same points that I hit. So
yeah, so you have 450 days and zero invested. That's not going to be good, especially in a bond portfolio when you're looking back 5 years when the bonds have been on fire going up. You want to have that capital working. So I'm not sure what some of the things are going on here. And then I need to make this screen just so it sits. There we go. Yeah, a little better. So yeah, we got zero here. Most of the time in this portfolio was 50% invested or less, and mostly or less. So you're not going to have any returns. I didn't go and look at the returns. I didn't even care because I'm trying to figure out what is the strategy. First thing, look at the constituents. What did I put in there? So the and
real quick on that thought, Bob.
I'm exhausted already.
So I thought this would be a fun one to go through. So first off, when you're looking at this chart, we've talked about this a couple times now. So hopefully you've caught on by now if you've seen some of the other videos. This chart is almost a mirror image of what it should look like. You should have all the bars stacking up over here on the right hand side. Right. Over in this area. Instead, they're all over here on this left-hand side. And it's actually creating a nice wedge shape, but it's the wedge in the wrong direction. So remember that VPM's allocation model is not an allocation model. It's actually a demand on capital model, which needs to be able. That's why the first thing I saw, 450 days, that it was doing nothing, zero. Right. And you had another 400 days that it only had, looks like 10% working. So you got 800 days of the back test where this thing was just in cash. It wasn't participating in anything. Now, most likely I haven't looked at that, but Mitch already knows where I'm going next, I think. Yep. Is probably some of these ETFs didn't exist for very long to the back test. And I guess we'll have to see how to verify that.
Yeah, so unfortunately we don't have access to this to actually tweak it and make it better, but I'm sure we'll be talking.
There's a few things that we can be doing.
So
we can do about this.
Question for you: is this a
Yes,
new
sir.
advisor?
No.
Oh, I'm sorry. We still love you. But yeah, it's So that this is good that I guess to have this, because this goes to show that you don't have to be a newbie to make some of these errors. And I wish we could do it. Actually, we can do a call-in show if the advisor wanted to expose themselves and come out and call in. That we're gonna start that next week. But this would be nice to know what the thought process was behind it. And
right.
when I got this, I would have already stopped this review, and I would have been calling you, whoever the advisor is, just to find out what exactly was the goal here. And that's why, and everything we've done in the process warriors and talking about that it's always starts off, what's the goal? What are you trying to do? And therefore, once you have that established well, you can start to determine the type of constituents that go inside of the portfolio to bring that consistency. Because let's face it, we need to have a solid story. If you go to Brandis or some big third-party manager, every one of their portfolios has a strategy, it has a story, and it has a purpose. It's got a why. Why are we
Right.
doing this? And that's really, really important, I think, for you to have that, because when you're sitting with a client, whether it's a new prospect or maybe this ends up to be something you want to do with a client, you've got to have that consistency. If it doesn't make sense to you, guess what? It's not going to make sense to the client as well. So the goal is to get very structured ideas, get them into the process, and then walk that forward. So, I guess when we've got, I think between Portfolio Expert and VPM 2.0, I think we got close to 10,000 portfolios. And every time I look at that list, I just start shaking, because I have no idea what you guys have done as far as building these things. And this is an example. And then, unfortunately, sometimes we don't get someone that was on the ball enough to ask us to review it, and they use this.
Right.
And they call and say, "Hey, we're really underperforming." We had a case about maybe 6-8 months ago, I recall, and somebody was massively underperforming where the market was going straight up last year. Well, they never got more than 40% invested because they had made some errors in updating their portfolio, and the allocation factor got all messed up, and there was no way for it to get invested. And
right.
I mean, it made returns. It was 8 or 9 instead of 19 or 25. It was huge. So, and just hate that stuff, and that's why we're trying to do this show, so we can alleviate those things. Because guess what? When stuff like that happens, guess who gets fired? We get fired because it didn't work. It didn't work very good. Well, it wasn't used properly. It's the old Primitive Pete story of the guy that used all the wrong tools for the wrong job. And used a screwdriver for a chisel and messed up a screwdriver. Then when he needed a screwdriver, guess what? He didn't have a screwdriver. So same thing here. I'm sorry to harp on this, and like I said, whoever this is,
this advisor could actually be watching right now. So we'll
that's
see.
okay.
I would encourage if this advisor that created this it does happen to be watching live right now, feel free to send us an email, support@vpmpartners.
No.
With just
we're calling you. We know who this is.
We will be calling.
No. We're calling you. We're reaching out. We're going all the way on this thing. We're all in for you. And that's the thing, folks. And gosh, I mean, these type of reviews. This is actually a good idea today, Mitch, to do this, because these type of reviews are so key to identify issues. Maybe something just as didn't develop what was to go in this and why it was to go in it. So don't take this thing personally. And then probably when we talk to you, you go, "Oh, we see what you're trying to do, and let's help you try to get to what you were trying to do." And I think that's one of the other shows that we're going to do is starting to, maybe there's really an effort to try to combine strategies here, and folks will try to throw it in there. So like I said, this is, you got the kitchen sink, right? You got the big sink and a little sink. This is a little sink on the side. This is the vegetable chopping block, one of those. So anyway, so I guess enough of,
Well, there's a couple
Okay.
of things that, so you had touched upon, you thought it was the inception. So I just want you to go through the steps real quick, just to show advisors how they can verify if that is the case.
Okay. Yeah, so we'll go over to active stocks, and we're just going to, so when, that was one thing I meant to look at. So I'm going to go back here just for a second. Oh, nice. That was nice. I just lost our connection.
It's all right. Hold on one second. I will, let me steer for you. There we go.
Yeah, everything got knocked out.
That's fine. We'll get
So
it back.
anyway, what I was going to go to, I wanted to see what I suspect it was a typical 5-year back test. So it goes to 09 now, beginning of 09. Is that correct, Mitch?
This one actually goes back further. In this
Oh,
case,
it does.
it goes back to January 3rd
Okay, I
of
got it.
2005.
Okay, so yeah, so let's take that's what I want to look at. I should have already seen this, but I didn't. And this was the inception date all the way to 05. Yeah, okay, so that's important to know where you started this portfolio from. And so when we get there, then we just want to go to the constituent list right away and start chugging through, hitting on the Q button. You know what I'm going to do is that's probably pretty small.
It's pretty small, yeah. If you
Yeah.
could, I think it fell behind it. If you just go and grab the other tab down here at the bottom.
Yeah. See, I'm on this guy here, right? Let's see here. There we go. And so I'm going to make this a touch bigger just so you can see this. And I think it will continue to come up that same size. So this one only goes back to 07, so there's one of the issues.
Yep.
A lot of these ETFs that are out there, or '07. It's interesting. The ETF strategy mill gets cranked up after a crisis. So if you want to look at start dates on ETFs, go to '02, '03. You go to 7, 8, and 9. Lots of strategies. Everybody, all the ETF guys try to fix the last thing that just happened, and then none of those strategies work anymore because that doesn't happen the same way anymore. So be careful about being sucked into some of these ETF managed strategies that manage the last crisis that happened, not the instead of trying to walk forward. And that's one of the things, you know, we've seen over the years advisors trying to build their own models and stuff. And with VPM, we have been out of sample since technically since 1994, and from the modeling standpoint, the buy sell.
What does that mean when you say out of sample?
Well, if let's say I decide to build a brand new process myself, well, I'm going to take some data and I'm going to put some buy sell strategies, maybe my own technical strategy, whatever, and I'm going to go back and go, oh wow, look how good that works. And everything looks good in hindsight. Now you have to walk it forward, and you have to see the in sample is what the data that you develop on. And so let's say, for instance, you could walk forward a bit. You could develop on a set of data that maybe from 2000 to '05. You'd probably want to do maybe 1995 to '05. You had 10 years of data, and then you'd walk forward '05 to current. So you can see what it did when it's never seen the data before. Because when you're developing a strategy, if you look at today's data, it's very similar to just taking a group of stocks and dumping them into VPM and say, show me what it did for 5 years, and you're going to go, whoa, this is amazing. Well, guess what? Those aren't the same stocks you probably would have chose 3 years ago, 4 or 5 years ago. You would have had a different set of constituents. So there's a benefit of hindsight. So there's a lot there. There's an article that I wrote on how I developed VPM, and then the walk forward process that was used. But we're out of sample for a long, long time. So any trade that VPM sees, it hasn't seen before. So anyway, let's go back to this portfolio. And we just want to click on these Q buttons. And this one's another '07. And Mitch is probably going to start laughing because he's already done all these. These are all '07s, it looks like.
One thing worth noting too, especially if you happen to select an ETF from a particular fund family, or select a number of them from the fund family, it's not too surprising to see that a lot of them started at the same time. So
yeah, this one's brand new.
Yep, So in the case of the Vanguard ones, you'll see that almost all of them started in April of 2007.
Yeah, here's a 1980. All the way back, this is the first day that our database goes back to exactly this date, January 2nd, 1980. So if you put IBM or something like that up there, it's going to go all the way back. Not sure what that is. Is that a stock, I guess, huh?
I think it's a stock. I also am not familiar with it. I don't have the Jim Cramer knowledge on this.
I know. Wouldn't that be nice? No. What a potentially annoying man. But yeah, so so here's another one, '07. So this inception date, number one, should have been started, and whatever the common date was in '07, that you could start and have the data. So that's as far as this back test can go. Rerun that. That'll certainly help it a lot. Still suggest on when you're building these things is that to make sure that you have, if it's bonds or dividends, have that theme that's playing out throughout the entire strategy. Maybe Snapple plays 10% dividend. I have no idea, but the point is that's what you want to do. And I wouldn't mix so much individual stocks. Maybe corporate bonds or some sort of strategy, something that you can come up with that tells that story, whatever it is. So I think we've sufficiently, whoever you are, beat you up. And it's just I wish I knew right now, and I will know when we call what what you were wanting to do with this portfolio. So Mitch, move on with your kitchen sink.
All right.
But so just in summary, a typical internal review is to check all the stuff. Did the constituents that I put into portfolio actually match with the statement on what I was hoping this would do? Are these the right constituents? You go through all the steps at all the meetings. I think we're probably about 10 meetings down now on this thing, maybe more, maybe 12. But we've tried to step forward. If you go through and watch all those, I know that's only about 12 hours of your life.
Yeah.
One of the things that I was thinking this morning is trying to find, when we do a show like this, if there was something significant or key, to actually send an email out and say, hey, if you go to our video today and go to 12 minutes and 40 seconds and watch the next 10 minutes, there's some really good stuff there. So we're going to start to try to figure that out as well as far as that stuff goes.
Yeah, so just to summarize a couple different things on this portfolio, one of the things I think it is worth mentioning is, we didn't actually look at the performance of this portfolio, because before we even looked to see if this strategy has performed well, we wanted to see, is it even constructed properly? And you'll notice that we just completely glanced over this page, even though it's the first one that gets loaded up, because truth be told, anything prior to 2007 is certainly questionable, because a lot of these didn't exist. We had one security that was added that didn't come into existence until 2014. So right away, there's some questionable things in here. So,
but I might add, considering it never used a capital, it's not terrible. And if you put this thing the way it should be, it's probably going to look pretty decent. But I would just say, making sure that you have the right constituents for whatever the strategy was, and maybe this person can make sense of this for us.
Well, one other thing that I thought would be a nice little side conversation, I guess we'll see how long this goes. Right now, I could only assume that the reason why these bond ETFs were selected was because of the low cost. It's that ETF desire that a lot of advisors have to just go out and grab an ETF for something that they're already using on the mutual fund side, because it has that lower internal cost. And I don't know about you, Bob, but I guess I'll put my own opinion out here. I've always been hesitant when it comes especially to bond ETFs, because there's two things at play here. One is you don't have that money manager expertise when it comes necessarily to going out and selecting all the quality bonds in it, quite to the same degree that you would on a mutual fund. The other thing that we're not seeing on this portfolio, even if we did take the steps to filter out, only work with these bond ETFs, we wouldn't see the distributions that get kicked out of these ETFs taken into account.
Yeah, I think there is some management going on the bonds, but not all of them though. Some of them are indexed to, if they're, it comes down, and especially the Vanguard is going to be an index fund. They're not going to spend more than 3 minutes figuring out what goes in there. They're going to grab something and do it. So some of the managed funds that you can find out there probably are better, and the word funds might be the right one versus I feel that on the bond side that there's a lot more value, or there's good value in mutual funds versus the ETFs, unless the ETFs can be categorized, as Mitch is kind of going down a trail to do that. So so we're going to have time to get through all this. We're halfway through the show.
I think so. We'll keep going through this. But again, if this portfolio were constructed properly, you would still see what would appear to be some underperformance, because we're looking at price return on these. If you're using bond ETFs, you're not seeing the distributions that have been paid out reflected in the performance on it like you would if they were bond mutual funds. So that's just one thing to keep in mind if you're working with bond ETFs, that the performance is going to be more conservative because it's not showing total return, it's only showing price return on it. All right, so let's segue from this to talk about this kitchen sink portfolio. And as I mentioned, this is actually fairly similar to what we just saw with this other strategy. In this case, there's 25 different ETFs that I went out and grabbed. And what I pretty much did is I went to the Guggenheim family of ETFs, and I just grabbed a little bit of everything. I tossed in some bond funds in there as well, because I wanted to create what we have often seen, which is this kitchen sink approach. So in this case, if this were a portfolio that an advisor were asking me to review, some of the things that would jump out right away, of course, as we've already touched upon, is the inception date. So again, going to the settings on this one has an inception date of the portfolio of January 3rd, 2000. It's pretty common to see an advisor construct a portfolio with an inception date of either 08 or 2000, because they want to see how it's done over various market cycles over the last few years. In this case, it does have the correct high activity, low liquidity, since we are using index-based assets. But the problem is, off these settings, the moment you go to click on the Q, so we'll grab the top one on the list here. Again, here's another security. The inception date is much later than the inception date of the portfolio. So this is a security that it could be a perfectly fine security, but within this portfolio, we're not seeing how it really should be done, how it should be managed in the context of a portfolio, because the allocation factor is going to be off. There's going to be a lot of dead time just sitting in cash.
I think we sunk our putt on this one.
All right.
I think you guys don't have it by now.
Well,
there's other things needed. We beat
right.
that horse so bad that,
So what I would do, in this case, as I said, I went out and I grabbed one fund family for the most parts, collection of ETFs. And one of the things I will just touch upon is, taking a look at the performance on this. So one common thing that advisors will do is they'll grab a large number of ETFs or mutual funds. In this case, we're going to say 25 is a large number. Now, what would you say, Bob? What do you think is probably a fair number of ETFs or funds to have in a portfolio?
I guess if you judge that from like our premiers, they're typical 5 to 8 are typical. Sometimes I've usually said 10 to 12 is enough, because here's the thing that's important to understand. If all 12 funds are owned, you're going to be under 5% allocation at that, and you have to be careful with these small little allocations. The goal of the strategy is to get big chunks of cash, get that demand on capital going, so when markets make turns, so let's say we get to cash, when they make a turn, you want to be able to grab big chunks. So I remember back in 2009 when we came in, I had an advisor call me and said there was no way they could put 31% of their money into EEM, and they should have put 100% of their money in it, as it turns out. But
right.
it was a big allocation. And then the following, I think it was 3 weeks later after that trade, another tranche came in, and we were 100% invested early on in April of 2009. And then when it came to around July, there was another tranche came in, and we rebalanced that account. So all of a sudden, all those big trades were moderated down to what the typical, I think we owned everything after July. So that means that whatever the ultimate linear allocation was would end up. So if you do 10 or 12, you should be able to take, if you're blending style boxes, like for instance the all-weather ETF has 8 in it, so it's got large, mid, small value, large, mid, small growth, and it's got a total bond and a short-term bond. And so the goal and that strategy in that was to be able to have an embedded bond, we got a short and long-term bond, and we got all the style boxes, basically a dynamic 9-box Morningstar strategy with an embedded bond. And so the theory behind that is do everything for me in one strategy, and you have to be careful. If you dilute it too far, then you end up actually not doing as well. And here's the other thing, sometimes like even this portfolio here, just looking at some of the returns, you might get similar returns. And when you start to look at like the trade profile, all of a sudden I got 25 stocks. I'm going to have 40 some odd trades per year to do this.
Right.
ETFDI did just as good with 5. So the point is to make returns, not to have. So you folks are always worried about diversity and all those things. You want, in the case of EPM, you want concentration, but you want to have rotation also from where you can go, and when the trends are there, you want to have as big as bet as you can and manage that bet with the sell discipline. But you can get too diversified, and in the end you don't get anything out of it except for more ticket charges.
Right.
And I know how sensitive that is with a lot of folks, but you'll look at it and maybe it does pretty good, but do you want to do 40 trades every year to make this happen? Probably not when you can do, I think ETFDI is between 12 and 16 max is all it does to, and it has, like a global equity 4 would have the same returns, and it's got a daily symbol in there.
Right.
So you might see, I think the max was 16, it might be 18, somebody will call me on that, but the point is that it's still minimal. It's still half of what we're seeing here to get equal to or better returns with we'll call less is better to a point. You want to have enough. Like I said, Global Equity 4 has got 5. You can go. The original ETFDI had a bond embedded in it. Had the SHI, and the point of that was to be more conservative. So everybody goes, well, it didn't outperform anything. It wasn't supposed to. It wasn't designed to. It never was. It's a global strategy, and it's compared to an S&P, and it's just not the right index as well. But it was designed to do what it was to do. The style statement behind it said it's a global blended strategy with an embedded short-term bond. The goal was back when I built that thing way back. I think it was like 2004 or 5 when I built the original ETFDI. It was everybody wanted a global mix then, and for the conservative clients, I put the bond in there. So at least when we didn't have equities, if the bond was short-term bond was working, we couldn't lose much, but we would raise the yield, and that was the point. So yeah, long answer. You got to be careful what you ask.
No, that's good. I'm glad you hit upon those, because we're gonna touch upon a couple of those points too. I tried to make this sort of like a cooking show, in that some of the ingredients were already prepared. So hopefully this is more like Julia Childs and less like Swedish Chef. So just one last thing. We're just going to go through very quickly some of the same steps. Again, you see that this one with a lot of these ETFs they didn't come around until much later, but because we did have enough of them, it's not quite as exaggerated as what we saw in the last portfolio, but there still is a lot of concentration over on the left-hand side, not enough on the right-hand side.
And you can see it was around 30% there. It was
sorry.
A lot. That's okay. No, there were a lot of days. I don't need to see it again.
Right.
It's all good. But yeah, it's about 30% is, there was a lot of days. It was like 450 days. So 30 is better than the previous example where there was 10. Matter of fact, what was it? Between the two, there's like 900 days of 10% or less. So those are the things you want to look at. And this trade profile button and then the histogram is where it's just going to give you the usage. And if you're looking at, actually a good contrast here is to look at the stuff that we pre-built for you, and even go to the trade impact chart on our dashboard and look at how those look there. And you can see not only the days accumulated, you can see other measures there that are helpful to understand how the capital is being used.
Right. Now, one thing that I think would be good to take a look at this, since I'm the one that created this, and I already told those of you that are watching that the way that I created this portfolio is I went out and I grabbed pretty much almost all of the Guggenheim ETFs. I also tossed in some bonds just to give a little bit more diversification. In this case, what I did is I went out and grabbed our global bond fund strategy and just loaded those securities up. So if I were having a conversation with myself, in this case, with the advisor that created it, I'd start off by asking the question, what are you trying to do? Why did you grab these ETFs? And so in this case, what I would say is I'm trying to create a equity-based portfolio with maybe some diversification on the fixed income side. But I want to see what I can do with this, and I'll just pretty much leave it at that, because sometimes that's the response we get. So looking at this portfolio, you'll notice there's actually some groupings here. We have at the top of the list, we have these broad markets. We have these equal weight indices, ETFs. We have the emerging markets. We have Russell 1000, mid cap, Russell 2000. So, coincidentally or nicely, because these are all similar in construction, they also have similar tickers, like grouped together. So that tells me that that's really one strategy in and of itself right here, similar to like the global equity strategy, in that it's taken a broad-based approach to investing in a lot of different securities. As I already mentioned, there's also mutual funds in here that I tossed in. So if I saw this within an advisor's portfolio, what I tell them to do is take out all these bond funds, put them in their own strategy, segregate them. Let's see how that does in and of itself. Because right now we don't have any sort of benchmark to work off of to say, is this portfolio even keeping up with what we're trying to do when it comes to having something to look at, because certainly it's not fitting any sort of logical basis, and it's not going to perform as well to expectations, because we don't know what the expectation should be on.
So what you're saying is break out the bond components, break out the equities, maybe build 3 portfolios or 2.
You got it.
And then see what you got there. Because one of the things that we do want to cover on this show is how to combine strategies to get to that suitability box that you're trying to get to. Whether it's 60-40, 70-30, 80-20, whatever it might be. Well, there's other ways to get there than trying to build all this stuff inside of one. And we'll have a show specifically on that.
As you go down further through this list, you'll see you'll see the components of the all-weather ETF strategy pop up in here, because we have the various different growth and value sides of the style box, just like Bob was mentioning. So there's a whole separate idea that's been tossed in here. It's not that it's a bad idea, but when it's been hodgepodged into this amalgamation of things, it doesn't make sense. So I would also remove this. So really what I have here is 4 separate strategies. I have the equal weighted index-based funds at the top of the list. I have those bond funds. I also have the all-weather strategy in here. Then lastly, I have all these different equal weighted sector ETFs in here. And so what I went ahead and created was a Guggenheim sector ETF. So in this case, I changed the inception date to 2009. Let's go ahead and see if I did that correctly. This is where it could turn into the Swedish Chef really quickly. So if we go to active stocks.
I don't think I've seen him or her.
And that's from the Muppets, by the way.
Oh, there you go. That's why. I haven't had young children for a long time, so there you go.
Yeah. So with this, if you click on Q, just like we did before, you see that in this case, this inception date is 2006. Again, the portfolio's inception date is 2009. So, as I click on a few of these.
You're back on that again?
What?
You're back on that?
Well, it's important because it gets missed, and as this advisor that created the portfolio, that has been a long-time user, at least 4 years plus, he missed this step, so it's worth touching upon.
Okay. We're still beating him up, so okay. Yeah. I didn't realize. I thought we let him go and to heal.
So what I'd like to say about this is similar to the core equity premier portfolio. In this case, we're using a different fund family that's created these ETFs, and in this there's a real logical story to tell around this. We're taking a domestic equity based approach to investing. We're using ETFs for their low internal expenses, and in this case we're using sectors.
So is this going to be like a rotation concept where we're going to switch out from maybe next quarter we look at some of these other sectors to flow in and take something out? Is that the plan?
Well, at this point it's all 9 of them, so it's all the sectors available.
All right.
They don't have 10 or 11. Depending on which fund family you go and which way of carving up the various markets or indices, they'll use various different ways of grouping these sectors. But in this case, Guggenheim has these 9, so that's what I went with this.
So it's kind of interesting, folks, when you do a strategy like this. Is a note that I'd like to put in is one of the things that happens is it goes to that diversification word again, and you're going to have segments of time where you have more cash because maybe a number of these elements. If you look at our sector universe right now, we don't own very many sectors. We're scaled back. We have more industry groups. Industry groups are a little more flexible, but for the most part, we don't own a lot of sectors. So that's going to happen with a strategy like this, where there are phases through the investment cycle through a trend. Like you have to look at, like, for instance, where are we in the trend of where we're at right now. So you look at, we've been since, we'll call it September, make it easy, September 2012, this rally started, this segment started. And so all of a sudden here we are, in June of 2014 going, this thing is getting really mature. So, those type of trends, when you get there, you're going to have more cash at this stage of the level, just because a lot of these things have run their course. They've flattened out. They've lost their momentum. BPM said, I'd rather be in cash than to have market exposure. And it's not really looking at, where the level is as far as, is it at a high? But it is looking at what the, what's going on with those. Everything's done all the decisions, the buy-sell decisions, are being done on that individual fund basis. So what ends up happening, though, is that these trends do get tired, and they roll over at different times. And sometimes you'll see things come back in, whether it's healthcare, or transports, or utilities, or whatever's on there.
Yeah, obviously, probably the easiest example would be financials. There's a fair share of time going backwards, especially if we had created this portfolio going back to 2007 or 2008, that we would not have been holding on to that financials ETF. So, you're going to see that take place, just like you said within the database, where we're not going to own a large portion of these. So the more positions that you load up within a portfolio means the less likelihood you're going to be owning all of them all the time or being fully invested.
Maybe we should extend the show for 2 hours and just keep on going. We'll have no one on it anymore by then. But it's just we're down to the last 10 minutes here, so I want to focus on whatever the hypothesis of this presentation is. But there's just, I guess, in talking about this, I guess our hope is, and once again we're soliciting your input, is the kind of things, we're going through a lot of detail in the thought process here. Maybe we should be doing more ABCs rather than all the thoughts and all the stuff. It maybe gets tiring, but I think that there's some really simple steps that you need to make in making these decisions. Then they're not really complex, even though we're talking a lot about them like they are, but they really aren't. They're really pretty straightforward concepts that you want to apply here and make your life easy. When I started this company, the goal was to make life easy, not hard. Right. And some folks are always making things hard, not easy, and that's just the way life is in human characteristics. But this is really, really simple. This strategy here, I don't know what the returns look like, but
let's take a look.
It's fairly random, the whole idea, right? It's just like here's all the funds. So
yeah, it's all the sectors. So it's a very simple sector rotation. We're just going to let VPM handle it.
Yeah.
And you see,
I want my money in this thing.
It works pretty well.
Yeah.
And it's done its job. And we could also take a look at things like the trade profile and that. But I will tell you that it did the proper use of capital. Of course, since 2009, there aren't going to be a lot of days where it was largely out of the market. Yeah. So this one is going to. It has been constructed properly, and really the basis that I approached it with was, I want to invest in the domestic equity market. How am I going to do that? I want to do sector rotation. I'm going to find a fund family that has a number of sector rotation ETFs, load them up, check, make sure the inception dates are right, and away I went. And that's what I did with this.
Yeah, and look, you're pretty much like everything looks. You're 50-50. Right. This is closer to 60-40 upside down. 60 in cash is 55-44. So that's going to be typical along the lines, and this is exactly what I'm talking about. Some of these sectors have been on a long run. If you look at, this year's returns only look like 0.60. If you look over like 12-month look back, it's completely different. So I think if we go to a performance real quick, the 12-month trail is about 10%. And I don't know when these things came, but if you looked at the 12-month trail in some of these funds, some of these things were, pumping out 20, 30, 25+%. So they've rolled off. So, where we're at from an investment standpoint is, is that 55-44, which is appropriate for what the market cycle is. Everybody's like, well, how's it doing against this year? That's not important. That's not what we're playing the market cycle. So you're going to see much different things. You're trying to always benchmark to the accounting date of 12/31. There's no relevance there because you have to really look back to how the funds have done, how they participated in their trends. There's a lot more to it than just comparing to the S&P index. It's pretty boring and pretty average to do that, I think. You really have to look at what's going on internally with this portfolio, and certainly I think this isn't even a fair comparison, but maybe it is. But throw the S&P against it, we'll see what it looks like. And S&P beat it overall, but it's also a sector strategy that is done. But still, it's went from 10 to 19 in the last 4 years or so, working on 5.
Well, and you're right. The S&P did beat it over this time period. Keep in mind, this nice little dip here right at the beginning. So there was still some downside to go on the S&P, and it wasn't until within the last 12 months that the S&P finally was able to make up that initial dip.
And if you've watched Market Thunder, you'll know that for the first time in about 9 years, the large caps are actually leading the markets. And this phenomenon started to happen back in late 11 when all the central banks came in and intervened and repumped the system up. And since then, in 2012, and especially this September rally 2012, you've seen these things really start to take over. So, and this is a weighted index. It's not a fair comparison as well to what the relative strategy is really doing. So, but
now, Bob, should I be concerned that this portfolio is only 55% invested at this point? I mean, shouldn't it be more invested now that we're at the top of the market?
Well, don't get me going. Yeah, he's trying to set me up, folks. And especially with 4 minutes to go, what to drop that bomb. But the bottom line is this: that's what I was just talking about. Where you are in a cycle of the constituents you have. Some portfolios are more invested in others, depending on the style box and how they're playing in, whether they're individual stocks or what they are. And you just don't get, the cycle where we're at is where we are. And this, like I said, a lot of these trends, if we went and looked at the trade log, this might be a little more reviewing. You can see that I don't know what these funds are, but the RYF 414 was a tranche of orders that we had. It was a fairly big tranche of orders we had come out that week, and it was literally the point in time where a lot of these trends stopped working. So the fact that some of these have rebounded off wherever that was sold, maybe the fund is actually higher. That's not what we're doing. We're trying to capture that. Remember that 60-80% of the trend, which we really most of those we did really, really well on capturing. Even with the expectations, tune into Market Thunder in the morning, but the expectations of where the market's going to go, there's another 3 or 4% maybe on the upside. The numbers look big to go from S&P, 1930 to 2030. Whoa, that sounds big. Right. It's not. It's it's a few percentage points now because the numbers are getting so big that the point values aren't doing as much as they feel like they're doing. And is it a low number, 2032? If we get there, yeah, that's a big number. 2070, that's only 4%. So it really isn't that significant. So in closing, Mitch, we have about 3 minutes to go. Why don't we go ahead and maybe talk about a couple of things there.
So as far as where we take this now, I hope that especially this show today, has been enlightening as far as how to really take in an idea and boil it down to a pretty simple approach. In this case, reducing that kitchen sink down to one strategy instead of 4. Again, taking a look at what we did with this advisor's portfolios, trying to find out if it was constructed properly. So what we're going to do, taking it to the next step, is what Bob already talked about, which is using some of these combined tools that we have as far as taking maybe a couple of these strategies and maybe out of that kitchen sink strategy we had 4, maybe we take 2 of these and blend them in such a way that it makes sense for the risk tolerance of your clients. And so on the next show, we're going to talk about how to actually do that and get to the right allocation to meet suitability, and then take it to the next step to actually talk about, well, how do you deploy this? What are the aspects when it comes time to actually taking that cash, put it out into the market, and what's the best approach to do that with? Either existing accounts or brand new strategies. There's a couple different variations to that get asked on occasion. So we're going to talk about that as well.
Okay. Well, I'm going to go ahead and I'm going to promo So much for a promo with no sound, right? Anyway, what I was saying here, while my lips were moving and there was no sound, is that we're putting a format in this show to try to get so you can have expectations what I'm going to be reviewing on the Market Thunder show so if you're just concerned, you want to know what's going on with the markets or an update, maybe especially tomorrow after the employment numbers come out, then you can know that that's where we're starting at. I'll go through Treasury and currencies. That gets us a half past the hour, and then we're trying to come up with like a tech lesson or some feature presentation. And then one of the things I don't see here is really, it's interesting. There's a time slot missing here, which is the stocks that we review. So we'll do the stocks each day as well. So I have to update this schedule. But anyway, so we're about a minute over, and I'll have Mitch come back. We'll come back for a second, but. No, we're looking forward to some of the things. I'm not sure we got to implementing what we were supposed to do here today. The on the fly review really got us down a trail, but it was good stuff. So
Right.
Next week we need to get to implementing this strategy and matching. There's a couple things that I saw just real quickly as we run over here. I saw in reviewing some things is implementing capital during using VPM during down markets. We also, right now is the easiest time in the world to do it based on the configuration of where we are and our strategies. But we need to talk about different cycles, market cycles, and applying the VPM strategy and how to implement those things. And it was a lot harder 6 months ago. It wasn't harder, it was just different. It took a higher belief system than it does right now, and we'll talk about that on the next Warrior show. So anyway, only 2 minutes over again. I think we went 2 minutes the other day. So like I said, maybe we should extend it for 2 hours. Just joking. So anyway, folks, thanks for coming again. We appreciate all the effort and the time that you spent. So if whether you're streaming it or watching it live, we really appreciate it. Have a great day. We'll see you tomorrow at Market Thunder and talking about employment numbers for sure. Have a great day, folks.